Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show, recording our 10th year of property podcasting. One of the originals. We'd never missed a beat. A couple of podcasts every single week for 10 years. Start doing the math. That's a lot of them. It's a lot of conversations with a lot of people. And from what I hear these days, there's AI models getting trained up on these podcasts, which is pretty good. The amount of depth of knowledge and information in them over a decade of recording. So that's cool. It means information is getting a lot more accessible. But I guess the responsibility and accountability is on continue to create really good content and information for our listeners, our community, our audience out there who are tuning into this or watching this wherever you are, most of you on the YouTube or on the social media shorts, you'll be seeing us. We have a number of different people coming to the show on a regular basis. We have a lot of property investors coming to the show. We have those chats and conversations with them to try and navigate and steer discussion around property. Obviously, we've been chatting about what's going to happen over the last period of time regarding the election. We'll give some more sense to that in coming weeks once the dust has settled and we know what's going on. That said, though, irrespective of what's happening in markets, irrespective of what's happening outside of your control, it's good to know about it, but you still got to march ahead and drive forward and do what you do and make sure that you're making the right decisions in line with your property investment strategy. Now, one of the things sort of popping around right now, depending how you view the world, some pretty tight markets out there, and that's tight by way of supply, tight by way of competition. A lot of people out there, tight in a lot of different ways. So I want to chat about this and what do you actually do differently in tight housing markets, particularly as an investor, and how you can maximize your particular approach, your strategy, your tactical execution to get the results that you want. Joining me in the studio, Lachlan Vidler from Atlas Property. Lachlan, how you going?
Good, man.
I like the colour shirt. I
you
noticed
do?
it when I come in. Yeah, it's
good.
good
We're both what, Ralph around?
Yeah, I know. I was looking at me on that thing. I don't know if white's a good colour.
You look all right.
It's all right.
Look all right.
Yeah.
Don't really think I've got a crush on you, but you look all right.
Now that I'm looking at screens over here, because now that it's not as sunny, I'm getting a bit whiter, so maybe they've got to do something with the lighting. But anyway, I need a haircut as well. I've just seen that.
I booked mine in for Friday.
Yeah,
it's too long.
Yeah.
Too long.
Where do you go? North Sydney?
I got a crow's nest.
Oh, do you?
Yeah, there's a barber up there. Pretty good. Been around for a while. Italian fella.
Okay.
He's pretty good.
Where there's that little hole in the wall in Crow's Nest where you can get your hair cut?
Yeah, it might be that one. It's called Antica Barberia. I think it's
Barberia.
Yeah.
That sounds fancy.
Yeah. No, it's hole in the wall. It's like right down the middle of the Crow's Nest strip.
Yeah, I think I know it.
Yeah.
What does he charge you for a haircut?
These days, I think it's like $45, $50.
When did that happen?
I know.
Cost of living crisis.
Literally, I know. Yeah.
Cost of living crisis.
Yeah, look at your barber to see exactly how
To be fair, I'm sort of a bit fatigued, and we've just gone through this whole election cycle, this sort of cost of living crisis that's been banded around for the last however long. I think it's just the cost of living.
Well, that's it. That's it. It's just I think it's definitely interesting, isn't it? And I think there is certainly something to be said for we have become very materialistic as a society, and it doesn't help when we're all punching money into the economy left, right, and center on
everyone's just trying to buy more properties.
Yeah, well, there is that too.
That's an investment, isn't it?
That is an investment.
And this is the Smart Property Investment Show where we talk about property and a property investment. So we'll do a wrap up of, again, we've got to wait for the dust to settle after the election to see what happens and whether or not all the policy ideas that were banded around pre-election actually take place and get passed and through into the hands of Aussies. So we'll do a big wrap up on that. However, you reckon markets are tight?
I definitely think markets are tight.
You're crazy. You're a madman. Why do you think that?
Every market that we're investing in, hot as anything.
So good markets are tight.
Yeah.
Okay.
Yeah. Of course, not all markets.
Not all markets are tight.
Of course, not all markets.
Okay. Yeah. I just wanted to frame that.
You know
probably.
what?
Yeah.
That's fair. It's all about framing, isn't it? Something. It's a word I've really been bringing into work and my vocabulary lately is framing, because everything is about a frame, isn't it? If you frame so the same thing said but through different frames has different results, right?
Correct.
So, good markets, investable markets, smart property markets are very tight.
Yeah.
Very, very, very tight. I was presenting a property to a client last night at 8:40 p.m. And unfortunately for that client, I was saying like we have to know first thing this morning, because if we don't, it's gone. Yeah. And we only had a day, 2 days to do all the due diligence on it, which I don't say only in the sense of like, oh, we've had to cut corners. Not that. More just that we had to prioritize this particular deal right up to the front of the queue, because we only had a day or two, and we were fortunate because we got given advance notice of the property as a pre-market.
So you're controlling. Did you put a deposit down on it, or did you had to make a call on it?
No.
For the purpose of So you hadn't yet controlled the property.
No.
Where was it? You're going to tell me?
So where was it?
Yeah.
It was in Queensland.
Oh.
I'll leave it at that. I'll leave it at that. It was in Queensland. Can't give away all the trade secrets, but it was in Queensland.
For those of you that don't know, Queensland's a pretty big place.
You know what? It's a very big place.
Brisbane's closer to Melbourne than what Brisbane is to Cairns, I think.
Is that true? I believe it.
Yeah.
I believe it.
Cairns, could be Townsville, one of them up there. Yeah. That's a big place.
Well, fortunately, it leaves a little bit of air of mystery. So if you want to know, come talk to us.
So what's been going on? How's your podcast going? Are they good?
Good, yeah. We were just saying it's very truthfully, sometimes it can be very hard to come up with content, right? But not just to get on and talk a bit of smack for with you or with some of the other people I do podcasts with, but to actually give value. But I love it. I really love doing podcasts. I love being able to talk about property. It is such a it really is so near and dear to my heart, and then how it can help people. But it's going really, really well. Like where, all the podcasts, like I've got one obviously off the Momentum Network, but I've got one on the Momentum Network, the Pathway to Property podcast. Everything is just moving so quickly. And I think probably more than anything, we get a lot of outreach from people just saying just nice things. Like, I listened to that and it really made me want to take action, or I heard that and it really shifted the way I wanted to think about something. And we do get a lot of business out of it, which is great, and it's awesome. Yeah. But I think more than anything, it's those things that I really like when people say, you actually just made a difference to me.
So people listen to them?
At least 2 people.
2 people.
Yeah.
That's all you
Me
need.
and you.
I don't listen to my own podcast, unfortunately. But,
you know what? Funnily enough, neither do I.
No.
Neither do I.
Occasionally see myself when I'm on the social media, there'll be a short of me talking about property, and I'll go, you need a haircut.
Yeah. Isn't it funny when you see yourself on, like I'm sure people have seen things like my ads around the place and stuff like that. It's really funny. You look in the mirror and you think one thing, but then when you go and actually see like your hair length or things like that, and you go, like you said, you really go, oh, God, I need a haircut.
Need a haircut.
Should have shaved that day, something.
Should have, yeah. I'll try and shave a little bit younger. But it's good though. But the amount of people tuning into podcasts is huge. And as I said beforehand, we've been doing this for like 10 years, right? That's a lot of podcasts. That's like...
Yeah. Do you know the episode count?
Oh, well over 1,000.
Not surprised.
Yeah, well over 1,000.
Well, honestly, I would have thought you'd be pushing like 5,000 or something.
No, it's not that.
Really?
But there's a lot of it in between. Well, yeah, it's probably a couple of thousand. Done a couple of thousand property podcasts. That's a lot of podcasts. It's a lot of people to chat to, and it's a lot of
talking.
A lot of talking.
Yapping is the word at the moment.
Yapping. I don't really yap. I might moan or bemoan. I might gibber.
Well, that's all right. If you want to be popular on social media at the moment, yap is the word.
Well, that's actually, yapping is not a nice
No,
connotation.
it's not. It's not, but it's the word that's getting around. It's and it is said.
What, I was yapping on social media?
It'll be people like when they'll go, when they are just talking a little bit too much and things like that, just going out to have a yap with my friends, things like that. Like
you go and have a yarn with your friends.
I am completely in agreement with you, but social media, the trend at the moment is the word yap.
Yeah, well, I would say if you're a yapper, it's a negative connotation, yapping.
I agree.
He was yapping on again, droning on, yapping on. Yeah, I don't yap.
Maybe you're showing your social media age right now. Those damn kids, with their yapping and their...
Yeah, it's just people wasting time.
You know what? It is. And you know what they aren't doing?
Yeah.
Smart property investment.
They're not smart property investing in tight markets. What's going on? Hey, last time we got together, you'd launched a portfolio review thing. How's that going?
You know what? It has been awesome. You're charging for it though, aren't you? We are. And it's pretty low cost. Like, if you were coming to us and you were doing, like 3 or 4 properties, it might only cost you, say, $500, $600, right? Something like that. But it's really great. And again, like, parts of me are altruistic. Parts of me are very capitalist. You know, we're here to make money, and
You're evil, then, are you?
Yeah, something like that.
Yeah.
But you know, from an altruistic point of view, it's actually we've had an awesome response because I know we briefly talked about it on the last podcast. It's been fantastic. People because I think the thing that really sets it apart is people come to us, and if we're reviewing, say, you know, 3 or 4 properties for you, you're getting like 25, 30 pages of deep analysis on your property, the market it's in. And we worked out from all the reviews we've done so far that there's an average saving for people of like 2 to 3K, right? And
on what?
In terms of like
decision making off the back of it.
Insight, yeah, exactly right. Insights that come out of it. And obviously, if you're somebody that has got everything put together, then the value might be having a set of eyes to really confirm it's still smart to keep the properties and how they're looking, performance and all that.
Yeah.
If you're somebody that's a bit of a mess and like maybe you haven't done this, or you haven't done that, or you haven't done that, being able to put it all in one consolidated document. So long story short, awesome result for people and awesome response from people. So if you are looking for that, the portfolio review, atlaspropertygroup.com.au/portfolio review, I think it is.
Oh, that's pretty easy. So yeah, fine. Just go to the website. You better
literally go to my website and then throw a /portfolio.
So what do
review.
you do? Just give some numbers and stuff, or
no? So we get into it. They have a very detailed questionnaire they need to fill in because obviously we need some information to do it. And then through our own data research, like I think I've talked about it before, like we've got our own tech platform we built from scratch over approaching almost 500 million unique data points in it, things like that. We go through, we do a full deep dive on the property, on the area. We then breaking down other aspects of property investment that they might be overlooking and things like that. Being able to give commentary on where they might be able to increase value and stuff like that. So somebody walks away, and like I said, 3 or 4 properties, you're walking away with, you know, between probably 20 and 30 pages of review into it.
Pretty cool.
So pretty cool. Like I said, it's, and more than anything, not a lot of people are doing it. And I'm probably more accurately, not a lot of people I think are qualified to really give that review advice and also at a level to take actionable insights. So that's what the response from people's been is, you know, they go to their accountant, the accountant goes, oh yeah, you made money or you lost money, that's it. Or they go to their financial advisor and the financial advisor goes, oh yeah, all good, but have you looked at investing in this managed fund? You know, or
surprise.
You know what I mean? Like, or they go to the property manager. The property manager goes, "Oh yeah, tenant's okay," but that's it. You know, like no one's really being able to provide that value to holistically look across the portfolio.
Yeah, and that's really the job of the property strategist, right? Which is
Yeah.
So you have buyer's agency. Being a buyer's agent is one application, one part, I think, of being a property strategist. So
I agree.
all right, well, that's good. So if you haven't done it, but look, I do it myself. I'm able to. I've been podcasting for 10 years and spoken to a
couple of thousand episodes. I
could probably work out, but I'd highly encourage people. You got to interrogate. You know, like it's only then you know, like and it's the unknown unknowns that you have where you just don't know what you're looking for and therefore you don't see it.
Yeah.
So if you get someone else to have a look at your portfolio, I highly encourage you. I still get my buyer's agent. I don't, you're not my buyer's agent, but my buyer's agent just still check my stuff out. And go,
I know.
Yeah. I do occasionally miss things, believe it or not. But here to talk about tight markets, and I think the perspective was, or the way you framed it was, good markets will probably be tight markets, and less good markets probably won't be tight markets. And this is what you need to look for. So let's get stuck into it because investing in tight markets requires a completely different playbook. We'll just go to a quick break. Stay with us. Back in a moment. Welcome back, Phil Tarrant, Smart Property Investment, chatting with Lachlan Vidler over at Atlas. Now, why a tight market requires a different playbook. How many people are still investing like it's 2022?
I think it's perspective, frame, as we've said a few times in the episode.
Frame of reference.
Exactly right. Like, you know, I think a frame of reference back in, say, 2022 was look at a map of Australia and buy a property and you're going to do well, right? You know, or, you know, we say 2022, but circa that period, right? That sort of very late COVID period when there was cheap markets were abundant, money was still pretty cheap. People still had significant FOMO. You know, like we hadn't just gone through the full rate rise cycle and people were feeling a bit funny, things like that. Yeah. So you'd be surprised how many people are still very much out there going, where's the cheapest market I can buy? Where can I buy for 300,000? Just things of that nature that isn't really applicable today, and also the way that they go and approach it, right? Of just potentially just going out and hitting and hoping, and not really being planned and not really being research backed.
It was pretty hard to get it wrong back then.
Exactly right.
You could put your money anywhere and it would have. Look, some markets performed a lot better than other markets. You think of, I know a lot of people who were investing or started investing in Perth in 21, 22. I think I got into the Perth market in 21. I think I was in there. And look, we all know what Perth's done, but this idea of we've just gone through this election cycle, and typically everyone's been talking about supply and demand. It's normally about the supply and demand of housing, and therefore making housing more affordable, which is a very different frame of reference for how an investor would look at it in terms of investable stock.
Yeah.
And investors are looking for something obviously very different than someone that's trying to buy a home to move into and raise a family, right? So two very different sort of supply and demand equations. But we're talking about this in or through the sense of property investment. Your position is that Australia's in a supply crunch.
It certainly is. And I think linking that also back to that sort of idea of not investing like that, loose 2022 period, or, a couple of years around that period, or you're definitely going to miss the opportunities of 25, is because we're in a supply crunch. And this is something I've very much come to realize through our own data analysis, through our, the platform like I was mentioning before, is that in times gone by, it was a little easier to be able to look at supply and demand imbalances and see how that was going to translate into performance, right? Because like anything, right? I was about to say property's a commodity. Somebody come and shoot me for that one, right? But like anything,
I think your greens friends would probably come and have a crack
exactly
at you
right.
about that.
That's all right. I can take the greens. They're fine. But property is an asset. Property is an item like anything else, where if there is more demand than supply, you expect prices to go up. But an issue that we're seeing today is that while we are in a supply crunch, there are markets out there that are still at critically low levels of supply but aren't seeing performance, right? And there is still demand seeing those markets, but they're not moving. And I think that's what I'm really getting at when I'm saying that, like, deep, detailed analysis is probably more required than ever, because just the basics of looking at property investing has changed. Because if you went and looked at a market, like I can tell you, there are a lot of markets around Melbourne and Victoria that for the last year have had inventory levels at around the 1 to 2 month level, right? And that would usually be a very key indicator to go, well, this is quite a tight market from a supply point of view, right? And yet a lot of those prices have not moved. And yet there are properties moving. So there is still demand sitting there. But for other factors, it isn't moving, right? And that's why, despite being in a supply crunch, that deep, detailed analysis and people who have maybe used old strategies or old methods of analysis, it's not going to work as well as it once did.
So this is sort of a sentiment or a mindset challenge that people are having. They've got to reframe. They've got to reframe their reference point to what the markets look like in order to understand and appreciate that markets are tight in certain markets, and how therefore you apply entrance into it. And you talk about Melbourne, for example, or some areas of Melbourne, like, yes, there might be properties transacting, but you're not seeing the growth yet.
No, and that's despite low levels of supply, relatively strong is probably the wrong word, but we'll say relatively safe levels of demand.
Yeah.
So at a level that you'd expect to see better performance than what has necessarily translated thus far, right? Now, we all know in 5 years' time, we go and look at the price of Melbourne, it'd be a miracle to not see it have moved, or Victoria as a whole. But I guess that's where it really comes, what I guess probably a big message I want to convey, which is that people thought, I reckon, 10 years ago, and I feel like it's almost crazy to say 10 years ago, it's 2015, but 10 years ago, right, property investing could be quite challenging, right? Like information wasn't as accessible. Markets didn't all just move in one direction, even though we were starting to move into a supply crunch even at that point. But I think generally speaking, a consensus would be property investing seemed a little harder 10 years ago, right?
Yeah.
We then moved into that COVID 2020s period where information became more accessible than ever. The supply crunch finally really occurred at a national scale that then really precipitated a significant moving of values everywhere. And everyone kind of felt like, oh, this property investing thing is really easy. Like, it'll be sweet, right? I think we are now moving back to that period because data isn't necessarily moving in the way you'd expect it to, where if you don't know what you're doing, you're going to struggle because you're going to make decisions based on what you think is sound analysis, but there are things that you're not taking into account.
It's a fair point, and I would add to that, if you are doing that, you're in a competitive environment with people who aren't doing that. and those people being buyers agents probably who are representing their clients. Yeah. So, you may be doing that and spinning your wheels and not getting the results because, you might be sitting around waiting for bargains or, taking a long time to negotiate on deals. You're not doing this in isolation. A good real estate agent will be there and don't think a real estate agent is your friend. And he's working with everyone else as well, right?
Absolutely.
He or she is cheating on you. It's not just you two guys doing it together. You've got other people in there, and a good real estate agent will be creating competitive tension at every step of the way.
Yeah.
And if you're negotiating in a vacuum thinking that you're working directly with an agent, you're very, very wrong. And the people you're negotiating against will probably be using very different tactics from what you are.
I couldn't agree more. And I think it's important for people to understand as well, even as a professional, we aren't working in a vacuum, right? No. Like we literally have a deal, we had a deal. It was happening at the end of last week. And then it was an agent who said offer cut off at this time and we were in on it. And then, the agent has just decided, you know what, I'm going to give it another couple of days. Yeah. And then gave it a couple of days. And then we kept pushing and he said, no, another couple of days. And we ended up pulling the offer because it's just not the way that we work. And we said, we're not going to negotiate us against ourselves. And if it's getting to a point like this, it's probably not going to be a deal that makes sense for us anyway.
A lot of people go, that's unfair. The agent shouldn't do that. The agent's just doing their job. Now, look, it depends what your view or perception of ethics are or whatever, right? But there's nothing wrong with that agent doing that. You could say, well, you should have kept your word and all this sort of stuff. But things change though. That might have been a genuine point at that point in time, and after subsequent to that, you might get a phone call going, I'm interested. It all resets.
I was going to say,
and goes again. As long as they're communicating effectively with you, I think it's sort of okay.
Yeah,
well, it's annoying, but it's okay.
If you think about frame, it's our word of the day, right?
Yeah.
If you're the vendor of that scenario, you think the agent's the best one in the world.
Oh, great.
Right?
You're pushing the price up.
Exactly right. If you're a buyer or a buyer's agent, you think that the agent is probably not the best person in the world.
Yeah.
But it's all about frame, right? Or if you're somebody who is looking at properties and you probably sit more in the middle of that and you see that the agent is willing to just do whatever it is to get a good price, that agent might be getting another listing. And you think that, again, they're pretty good. So it's all about frame, right? And at the end of the day, you can spin your wheels about it as much as you want, but
it's the name of the game.
Exactly right. And at the end of the day, it is what it is.
And this is the point for a lot of whether they're owner occupier, but we're speaking specifically of investors. Like people start off investing, they get really excited about it, they absorb themselves in it, they listen to every single smart property investment show ever done. They're informed, they're educated, they're ready to take action, and they start down the pathway of going to open homes for Wednesday nights and Saturdays for 6 months. They get highly invested. They go through everything. They've got a little thing saying, we like this one here. And they're just perpetually disappointed because what normally happens is that markets move a lot faster than the individual if they're inexperienced. It's just the way it is.
Yeah.
The speed of decision-making is absolutely critical. So when markets are tight and there's a lot of competitive tension for all things we've spoken about, you've got to be absolutely nimble. And you've got to be able to be pragmatic, and if you don't have the experience, you're going to fall behind. And what will happen is that you'll get fatigued and eventually you'll probably just go and use a buyer's agent, or you'll get fatigued and go, I can't invest in that particular market. It's too competitive. I'll invest somewhere else and maybe get an inferior property. Just saying.
I literally could not sum that up any better.
But that's okay. If that's what you want, get stuck in. I don't want to do it. Last thing I want to do on a Saturday is look at property.
No, and I think that's the thing, right? Like, it's all about opportunity cost. Like, you think you're that person that wastes 6 months.
Yeah.
And then you go and pay somebody to do it the same amount that you would have paid them 6 months prior, if not potentially because demand for, I can tell you, for demand for our services, we've raised our prices 3 times in the last 18 months, right? And I know that some of the other people that are our competitors are not that dissimilar, right? You may, in that 6 months, pay more for starters on your service cost, but even if you pay the same, you've then got all the opportunity cost of what's been lost on that property. You then sign up 6 months later. You're not buying a property the first day that you sign up. So it could be another, it could be another 6 weeks, 8 weeks, 10 weeks, by the time things get in order. Like it's, people have a very short-term mindset in a lot of things. And that's something that I think we're going to mention today.
Yeah. All right, let's get into this. So I think we've painted a pretty reasonable picture about what's going on. And not all markets are tight, but
no, some are very loose.
Some are very loose. I tell you can get some bargains out in Broken Hill at the moment.
I was going to say,
you still get properties under 100K in Broken Hill. They still exist.
You know what? I'm not even going to pretend to have any authority on the matter. Haven't even looked.
Never. Yeah, no, but so good markets will typically be tighter, and it's just the nature of the game. Or you're in a market so early before it gets tight, and that's the holy grail, right? So let's talk about the 5 things smart investors do considering the status quo, the environment they're working in, and with a view towards your experience and competitive mindset and all this sort of stuff. But before we get there, we'll go to another break. Stay with us. We'll be back with the Smart Property Investment Show in a moment. Welcome back, Phil Tarrant, Smart Property Investment. Lachlan, Vidler at Atlas. I can't believe we're already in nearly halfway through the year.
Literally, I said to my team, we have
just sitting there thinking like Christmas just happened, but
literally, we have a company-wide meeting once a fortnight just to give everyone a bit of a razz up and talk about important things and everything. I was saying to everybody, like, we are literally not more than a few weeks away really from end of financial year.
Yeah.
Like
that's crazy.
Like,
I don't know how it happens. I just don't know how it happens. But and we're now moving into an environment where you say it's going to be categorized. Again, it all depends what goes on. But, the money markets are saying this, that we're moving into an environment with decreasing official interest rates, and therefore that should translate into cheaper mortgages for everyone.
Yep.
Stimulus for first-time buyers and all this sort of stuff. If I would say the market is only going to get more competitive than less competitive, and I know there's big, bold ambitions that they're going to be building all these houses. They're going to be build the houses that house the Australians of the future. Just assume there's going to be competitiveness and tight markets moving forward in good areas to invest. So what do the smart investors do, Lachlan? I would say the first thing would be they would invest on the basic fundamentals of the markets they operate within, not through fear of missing out or something like that.
I would 100% agree. And I think that really goes to the heart of a lot of this conversation because a lot of people are going to have FOMO from the start of COVID period. Then things tapered off for a little bit. Then things picked up again. And there's probably been 2 periods of FOMO over the last 2 years. Sorry, 2 years. Over the last 5 or so years. And as money starts to become cheaper and that gives possibly more people the option to get into the market, it's already starting to create a bit of a frenzy, right? Like I can already see that's happening. But buying based on FOMO is not a good idea, right? And I'll give you an example, right? You have to buy based on fundamentals. And then you also have to buy based on fundamentals that are appropriate to your circumstances. So here's the example, right? Victoria. Everywhere you look, somebody is saying something new about Victoria, right? I reckon if I went through Spotify and Smart Property Investment podcasts and I saw the last 10 podcasts, I reckon at least 5 of them probably mentioned Victoria at some point, right? At least, right? That creates FOMO, right? People have this fear that they're going to miss out on Victoria/Melbourne and what's going to happen, right? But from the way that the numbers look right now, there may not be really strong performance, in my opinion, for 18 months to 2 years, right? There could be, and I'm sure there's going to be some pockets that do quite well, but at a more macro scale, you're probably not going to see really strong, sustained performance for probably 18 months to 2 years, right? Government issues, policy issues, obviously finance issues right now. You've got tenancy issues, which probably goes into the policy side, right? There's a lot of things right now that impact Victoria broadly, right? So if you've got a fear of missing out and you're an investor and you have the ability to maybe buy a couple of properties and you go into there, you might have your capital sitting effectively dormant for 2 years or 3 years before you can really have enough equity to pull to go into your next deal, right? But if you invest in a different market, then that equity could be developed a lot quicker that allows you to leapfrog into more properties over that same period, right? So that FOMO, rather than fundamentals and fundamentals applied to your situation, could hamstring you. But then the flip side is if you're an investor that can only buy one property and having quick equity uplift is not that important to you right now, it might make a lot of sense. And you might then be buying a little bit on FOMO, but you're still using the fundamentals and the fundamentals applied to your situation.
Yeah.
You get the full upswing. But if you made 150K of capital growth in the next 12 months, it's not going to impact your situation to acquire more property. So it doesn't matter so much, right?
They're good points. And I'd sort of tend to subscribe to your sort of overall position on Victoria or Melbourne in particular. I think there will be good buying down there, but it's not like you're going to miss it if you don't invest today.
Exactly right.
You know, and for certain people, it will be a good market to invest in right now. And I always come back to this position of I started investing in Queensland about a decade ago, 2015, 2016, after a pretty good run in the Sydney markets, and it's similar. The market dynamics are different, but the base philosophy of it was very similar. As in, here's a market that's going to move for all these reasons, right? It took 2 to 3 years before it really started.
Anything,
yeah. Like, you know, it was sort of slow all the way through to 2018, 2019 probably. Yeah. Then it shifted into gear, right? So I held property in Brisbane, quite a lot of property in Brisbane, for maybe 4 to 5 years without it was mediocre, right? And then it just I've still got
it's
all
very honest of you.
I've still got all these properties and they've really moved the needle, right? You know, and this is the point. I didn't invest in there for FOMO, thinking I was going to miss out. I invested there because it was the right time to be investing there. I just had to wait a lot longer for that right time to keep up. And I think you're going to get that. I think that's going to happen in Melbourne. Now, the issue you have, though, is that a lot of people have been investing in Perth and are still investing in Perth for thinking of fear of missing out. Maybe you've missed Perth. I don't know. I don't have a position. It's above my pay grade. But so people go, where else do I go then? Where's going to be the next Perth?
And that's the FOMO, the hype, right? And I think I definitely agree with you. And I think the two things I really take from your story to apply to the first of the 5 things that smart investors do of buying based on fundamentals and not FOMO is that, like, first, I would say probably, because we're in a different time, right? Like, never more access to information, all the rest. Brisbane/Queensland probably didn't have hype in the same way that Melbourne is starting to generate a hype, right? Yeah. Because, like, smart property investment was probably only just starting around 10 years ago, right?
Yeah, it was.
So, you know, media wasn't around as much as it was. Of course, it's always been in newspapers, but it's never taken the focus it has. The buyer's agency space didn't really exist too much. You think like there was a lot less hype, right? So you bought based on fundamentals. And then I think the second thing is that when the fundamentals were then applied to your situation, you still had the ability to continue acquiring other properties. You weren't like most people probably as hamstrung into, if this one deal doesn't do well, I'm capped and I'm out of it.
No, it's a very different situation.
Yeah.
It's a very different situation. And it wasn't my primary wealth creation vehicle either.
Of course.
I was doing it largely because it was good to do.
That's fun too, I bet.
That's fun. Yeah, it's good. Yeah. It's funny. Probably used to be a lot funner.
Yeah.
Probably used to be a lot funner now. And now I'm trying to sell some stuff right now and I'm getting texts. I'm just going, whatever. I wouldn't want to be a buyer's agent. I just go.
You wouldn't want to?
No, not for me.
I will say people.
Do you reckon I get a job as a buyer's agent? Someone hire me, do you think?
Let's be honest. You would hate to work for somebody. Yeah. You would have to be your own boss.
I could work with someone.
You'd have to be your own boss. I feel like I'm the same way. You know,
maybe
my partner.
You reckon
and her family,
I'm unemployable?
No, because you just go start another business.
Yeah.
I think once you've started a business and you've had any level of sort of success that's meant that you haven't had to, fold up like most businesses do. It becomes very hard to go and work for somebody else.
Someone else. Yeah.
Not impossible. I mean, circumstances change, of course, but I think it'll be challenging.
It'd be crazy. But so fundamentals are good. So what would be the second thing smart investors do of the 5 things when investing in a tight market? So this is throwing away the old playbook and creating a new playbook.
Yeah. They move fast. And they move fast because they're prepared. Like the story I was telling you before, because our client had their structure set up, they had their pre-approvals in place, their broker knew exactly what was going on, their accountant knew what was going on because there was a bit of a sophistication in this client that I was speaking to. That client was able to be in a position to make a decision within overnight, right? And realistically, I called them almost at 9 p.m. last night, and the call was set for before 9 a.m. and they had to sleep in that time. So they're making a decision.
Did they make the call?
They did make a call. They did make the call, right? And they moved fast.
Was it a big decision for them, or was it just?
I like to think when people go through our process, because we're very structured. It probably takes on my military background. We're very structured, very well communicated. There's more research and analysis than most people can possibly comprehend, but still delivered in a way that allows the layman to understand exactly what's going on. By the time it comes to the point of making a decision on a property, when we then present it, they don't feel like they're missing information or there's any hesitancy. I think hesitancy comes from a lack of understanding.
Yeah,
they have that already.
That's important. So they're conditioned to make a decision, and if you,
that's it.
And therefore you can make it fast. Like,
yeah,
I'll make a really quick decision, but it'll take me some time to get there. Sometimes I need to absorb all the information, and I'm a big proponent of like strategic patience.
Yes,
where it's sometimes the decision makes. It's good to be patient, let things percolate, and typically the right decision will emerge. And when it's time to make a decision, make it fast. But nothing's really changed. I remember back in a decade ago, even longer, buying properties, and it'll be like, you've got to make a call right now on this. And with property, and depending where you're buying in Australia, it's forgiving to make decisions, because if you're buying in Queensland, for example, you could say, yep, I'll sign a contract, and go, yeah, I'll sign a contract, no worries.
Yeah.
You give it back to them, you give them 0.25%, which isn't a lot of money, and that sort of sits in a trust account somewhere. And then you've got time, if you negotiate it well, 14 days, 21 days to do your due diligence, and you can pull out of that contract at any point in time, get your money back.
Exactly right.
So making a decision to sign a contract ain't that big a deal. Like, and there's a really, really important point for people. Like, if you do it the right way, it's just giving you control of the property to allow you to give you time to make your decisions, get finance, pest and building, all the other stuff you may need.
Yeah.
And you can even use that time to get early access, all this sort of stuff, right? But, it's not that big a deal, because you've got ways to get out.
Absolutely. And that's something we talk to a lot of our clients about when we're doing a deal is, look, at the end of the day, you've got 14 days, or typically 14 days, for your finance and your building and pest. And at the end of the day, the way that Queensland has a building pest set up, you can terminate for any reason, right? Other states might have things like, it needs to be a major defect, things like that. Queensland, as an example, anything you want. Now, is it good business or practice to be cancelling contracts based on, like a nail out of place? Of course not.
No, you'll annoy real estate agents eventually.
Right? But if, for example, it's been positioned from us especially, because realistically it's our relationships that get hurt, not the clients. If even we've positioned it to the client as like, look, we just need to lock this up, right? We need to control the deal, and by doing that, we need to sign it off. And if we really get to that point that there's other things that don't stack up, we could terminate it because of the nail out of place. At the end of the day, it's only our relationships that get impacted, not the client. And if we're the ones setting them up, framing it for them in that way, it is what it is, right? Like,
as a tactic, I wouldn't recommend.
Definitely not,
because it's. It might work well once, but you're going to burn it. So, like, if you're going to sign a contract, I would say that you've got to be pretty committed to doing the deal.
Absolutely.
You're not doing it on the basis of finding reasons why not to do the deal.
Yeah.
You're there to do the deal, and it's just giving you time to do a proper due diligence on it. And you can also use that time also, like just going, no, I don't want it for whatever reason. It's not going to get you very far, but you might be able to negotiate a couple of grand off here and there because there's a nail out of place or whatever. But
for sure,
speed is key. I think speed is key.
To me, speed is your unfair advantage, and it doesn't matter whether you're using a buyer's agent or you're doing it individually or whatever the situation is. Speed is your unfair advantage, because I can promise you one thing. I can tell you that a client that works with us, and that client is an easygoing person, listens to what we say, challenges us when appropriate, but works fast and understands, we want to bend over backwards for that client because we know they're a great person to deal with, right? And same thing for an agent. Speed is your unfair advantage. And especially right now, like you can look at it at a micro level, like deal to deal of going, speed's your unfair advantage to actually get something locked up, you can also look at it over, say the next few months and things like that. People are still waiting on the sidelines for further rate drops, for example, right? Or other things to happen at a more sort of, medium to larger scale, like from the economy point of view. If you're willing to act now and take speed to get something done, like let's all use common sense for 5 seconds. Rates go down, people's borrowing goes up. We're in a critical supply shortage in everywhere, let alone good markets. What do you think is going to happen to even a semi-decent property if you just act faster now?
Yeah, and being able to move quick is critical, and investing on the fundamentals absolutely critical. Doing it fast, but I imagine that's highly connected with your third point here, of how do you actually do that right, and that's using the right advisors, right? That you need to use the right advisors in tight markets.
Absolutely,
because all you're trying to do is you're trying to set yourself up for the greatest propensity for success.
Yes,
is what you're trying to do. And
yes,
you can do that yourself. That's cool. And the last few properties I've since the COVID pandemic started, I've probably bought $8 million in property or somewhere or other. I've done
good effort.
I've done it all without a buyer's agent. I've done it myself, right? However, I have a lot of quasi advisors, which is pretty good. And my quasi advisor, I can just pick up the phone and go, hey, I'm looking at this. What do you reckon? Someone go, yeah, that's pretty good. Yeah, that's pretty cool. So, but you've got to use the right advisors.
I was going to say, for the average person, there was someone said this to me the other day, and I thought it was a really great sentence, right? And it was trying to beat professionals while treating investing like a side hobby. Not only is that not going to lead to success, but it's not really a scalable game plan either. And it's so true, right?
Absolutely.
Like, we're now in a position, like we've talked a lot about the past in this episode as well. We're now in a position where like real estate investing has never been more strategic. Getting the right decisions right has probably never led to better outcomes for people. And in the same way, getting the wrong decision has probably less downside as it may have done in other circumstances, but your opportunity cost has also then never been greater. So like, it's not about, like, this isn't a plug. Like, at the end of the day, we have lots of people that come to us based on the podcasts I do here and other avenues and things like that. This is certainly not a plug for that. This is more of just putting out the most obvious bit of information, which is that the right advisors are all professionals in their field, right? And in a lot of circumstances, yes, we are talking about like a buyer's agent, but it is also your broker, it is your accountant, it is other people. If they've spent their life or their career dedicated to their field, in what world do you have the audacity to think that you know more than them? In what world? And I call that out so bluntly. In what world do you really think you have the audacity to think that you know more than them? Yeah. So don't think you know more than them. Pay your accountant the $2,000 to do your tax return and maximize your results. Pay your buyer's agent the 15 or 20K or whatever it is to have them go and make you 100K in 12 months. Fortunately, you don't have to pay your broker, but go and listen to your broker. And if you have really complicated circumstances, some brokers will say, hey, look, I need to charge you a bit of a time fee. Yeah. Like, you are coming to me with this and that and that and that and that and that. I need to account for that.
I should be charged to be my broker.
Yeah,
right? And I'd happily pay a fee for service because my stuff's probably a lot more complicated than
exactly
most.
Right. But if your broker turned around to you and said, look, Phil, I appreciate your business. I'm not trying to drive a wedge here, but you got to understand that for me to do even one deal for you with the complications of, your business income, your property income, I'm sure other stuff you have going on, I need to charge you. I probably need to charge you $1,000, right? But we're also doing that on a portfolio worth millions and millions and millions of dollars. You obviously trust your broker. I bet you'd probably say, you know what, fair enough.
I'd pay in a heartbeat.
Exactly right.
It's just sorted out for me.
Right. And that's it, right?
For me. But it comes to the point now, not all advisors are created the same, and you've got to use the right advisors. And, not all mortgage brokers are created the same. Some mortgage brokers are great at doing first home buyer stuff, right? Where you go, give me 2 pay slips, you're a couple, really, really simple and easy. There's a lot of brokers who wouldn't be able to do financing for me. They just wouldn't have the sophistication to do it.
Yep.
Much like accountants. Like, one of the challenges I see a lot of property investors fall into and it's not a bad challenge, but you've got to be conscious of this, is that they outgrow their accountant.
Yeah.
You know, they've gone, oh, we've used this person, our family's used it for years and years. They've done our tax returns for years and years. Gets to a point where you may outgrow your accountant, depending on your level of sophistication and whether it's property investment or any other asset class or business or whatever. Like, you may outgrow your accountant. One of the things I speak a lot about on this show is that, you know, there's a lot of buyer's agents out there right now, and I would say not all of those buyer's agents are good buyer's agents, particularly when they are part-timers and they go and do a course on the basis they get paid a commission for finding people. It's like, this is the language that's getting used now. A buyer's agent gets paid a commission for helping you find like, if anyone's getting paid a commission, that's not a fee for service. That's something very, very different. Yes. And I'd be very conscious of it. I know you're on Pippa, right? This is a big deal. Like,
of course.
I've heard this language start coming. Become a buyer's agent, get paid a commission for helping people find a property. That's a completely different thing.
I agree.
Yeah.
I agree. And I think this is where, like you said, it really comes down to not all advisors are created equal. When you find a good one, right, ask them, take their recommendations, right? You don't have to blindly trust. I'm not telling people to blindly trust. That'd be silly. But like I said, if you've got people that are have dedicated their career to doing this, they're being referred or introduced to you by other people that have demonstrated that they're pretty damn good at what they do, maybe there is something in there for you to take away, right? And I think about our partners. Like, I will very transparently say here, partners that we started, and when I say partners, I don't mean people that are in bed with us or anything like that, like other businesses that we use, that we refer our clients to, we have outgrown a significant number of them from the day that I started Atlas and the first clients that we had versus where we're at now. And like, we are now starting to deal with a far more sophisticated client compared to what we used to, right? And we love our mum and dad investors, right? And they're still our absolute bread and butter. But some of them are also very educated and very intelligent about what's going on. And they're not just somebody who doesn't have an idea. Yeah. And some of it, the partners that we used to refer clients to, we have outgrown because they're not fit for purpose anymore, right? Like, either their service quality has dropped and we've said that's not appropriate for us, or where, you know, it might be different types of clients we're seeing more regularly and they can't service them. So it happens,
and that's okay.
You need it, you know, you need the right advisors.
You do need right advisors. So, you know, why investing in a tight market requires a different playbook. So that's the third point, use right advisor. What's the fourth one, Lachlan?
Fourth one. All right. So you need to think in decade, not in news cycles, right? This is something that people really, really just, because we now live in the day and age of TikTok and Instagram and influencers and what we're saying, for people yapping on and doing all the rest, right? People have become very materialistic. People have become very short-sighted in what they're looking for. And I'm not, you know, anyone's offended. I'm not trying to offend you out there, but if you are, maybe it'll make you think about it a little bit differently, right? But you need to think in the longer term. Property is a long-term asset. You can make money in the short term, right? Like, you can make money in 6 or 12 months. I'm not saying you can't. We make our clients a lot of money. I think we average $100,000 in the first 12 months, right? As from, you know, all the clients we bought for. I'm not saying you can't make money, but the point is that you don't build a portfolio overnight, right? Like what we're talking about with Melbourne. Don't think in the news cycle of this. Think about the fact that, is it right for you to be there today when you might not get equity to use for 3 years? Should you be somewhere else, right? Are you in this market because you saw a couple of clickbaity things on Instagram or Facebook, but you really know nothing about the market, but you're just thinking in the news cycle because you've seen a few other articles about it, you know?
Go back to social media. Most stuff you see on social media is hacks. You know, like, here's a hack. Everything's about a hack now. So, like, getting something without having to put the hard work in, or getting around it by some different way, or making money, how to make money quickly, or here's a hack to get something, which typically used to take a long time to do it. It's hard to hack property. It's really hard to hack property. And you only just need to look through history to actually work that out. So, you know, if you're consuming that stuff, getting clickbaity stuff, oh, I can make that really quickly. I've got a property hack for you. There's no hacks in property. No. Right, it's time. And I'll probably butcher this anecdote, but it's a good one. It's a senior person, a senior Chinese official was speaking to a senior French official. Yeah. At a cocktail function. And the senior French official said, what do you think, to the Chinese person, what do you think about the French Revolution? And the Chinese official said, we don't know. It's too early to tell.
Does that not go to show exactly? I mean, China has the 100-year plan.
They think in generations, right? They absolutely, and that's pretty much saying they're going, French Revolution, it's hundreds of years since it, but it's still too early to tell what that actually means for France because there's so much more still to happen, right? So property, if you're thinking, we've just sort of gone through an election cycle, right? Everything through the election cycle is the immediacy of like the next 6 to 12 months. Here's some tax breaks.
Which
here.
Kills me.
There's all this sort of stuff, right?
Kills me.
No one's thinking. No, and I've been sort of quite vocal about this through that whole election campaign. Like no one has spoken about that the housing, inverted commas, housing crisis or affordability crisis with a generational view. It's all this immediacy of going, we'll get more tradies in to help build houses, or we'll do it like, and these are all the smaller stuff which is important, is tactical level stuff, but no one was able to really, I believe, really speak it at a strategic level, absolute strategic level about this is going to be the generational planning to support housing affordability. You're not going to fix housing affordability in a heartbeat, right?
Yeah.
It's going to take generations of long-term strategy making. And back to my point, China thinks in generations, in hundreds of year blocks, even longer, right?
We are to blame though, and I'll say this just before we round out our 5. We are to blame, right? Like, across all of it, right? Like, I think about advertising. I think about the advertising we have to do. People click on the stuff they shouldn't click on.
Yep.
Right? Politicians have to market themselves based on the next 12 months or 18 months.
Yep.
Because if they got up and they said, here's our plan for 10 years, it wouldn't be sexy enough because we all have too short of an attention span.
Well, you see the coalition came out during the campaign pretty much going, you're a defence guy, here's our defence plan. We're going to try and get to 2.5% GDP in 5 years, and within 10 years, we're going to get to 3. And everyone's going, it's 10 years away. It doesn't matter.
Exactly right.
Don't worry about it. Don't worry about it. Everyone wants to talk about now. Where's my sugar hit? Where's my electricity rebate?
Yeah.
Where's my fuel excise, rebate? Where's my this, that, and the other? So back to the point, smart investors think in decades, not in news cycles.
And I think to round it out on a very simplified way to think about it, the people who have made the most money in property over the last 5 years, which is almost counter to what I'm saying about thinking in decades, right, are the people who were investing before COVID started, the same people who then invested when everyone thought the sky was falling, the same people who then invested when rates started going up and they hit, rate increase number 10, and they're the same people investing today. Yeah. Because it doesn't matter what the headline is, it doesn't matter what's happening in the economy, it doesn't matter for any of that. They understand that as soon as you can buy property, you should be buying property.
And property is interesting also because what you see and what you hopefully you don't get on this show, but typically on your social media, people yapping about property, right? Who are all there talking about the next big thing in property, blah blah blah. The real people, you scratch the surface and go and have a look around.
Yeah.
There is a lot of very wealthy families in Australia who have created generational wealth through property, and typically they're sort of, I'll generalize here, just old Greek families who have been at it for 3 to 4 generations, bought stuff, late, coming in Australia as migrants in places like undesirable joints in the inner cities of Sydney's or Melbourne or whatever, way back when. They've held on to these properties for 3 to 4 generations.
Yeah.
And they're worth squillions. And they've said nothing about it.
Yep.
They've just kept their heads down. They're not yapping about it. They're just good long-term predictability of property. Buying it, holding it, often working in them as businesses.
Yeah.
And you look around and, you see today, you go to maybe the inner suburbs of Sydney or your Petershams and Lewishams and those sort of areas, you'll see a whole row of 20 shops. Go, one family owns that. Like Kirribilli, not far from here. Kirribilli is owned by about 3 families.
Yeah.
The whole of the Kirribilli village.
Yep. My partner, their family's Italian, and a part of their extended family owns half of one of the biggest roads in Bondi.
Yeah.
And I'm not talking about shops. I'm talking about like just house.
Yeah.
Right?
They would have bought it when it wasn't that desirable and sat there, done nothing.
Exactly right.
Just
smart.
Just smart.
And you know what? Honestly, from everything I've seen with working with people, what I find a lot of the time is a lot of those ethnic migrant families, they know how good they have it here. They are willing to sacrifice, and that gets passed down to their kids and then the grandkids. And of course, you hit a generational line where it's like, now the family has been around Australia so long that a little bit of that almost hunger might get lost.
Maybe.
But you still get that impact from the generations, especially from first, second, third generation families, especially when the migrants themselves are still around, are still
it's
alive.
great. But you just, we're generalising, but
Of course,
Greeks,
yeah.
Italians, like.
But I see it so. I honestly see it so much.
It's super impressive, and they just go about their business. They don't say anything.
They're very quiet, humble,
smart.
Yeah,
you learn a lot. But this is the point.
Yeah,
they think in decades, right?
Yep.
Like, the successful property investors aren't the people yapping on social media. They're the people you don't hear from.
Great use of the word. Yeah. There we go.
Yeah. So the fifth thing, then we'll finish out this.
Yes.
What is it? How do you change your playbook? What do the smart investors do in tight markets?
They leverage their resources wisely. And I think this is a great point to end on, because it kind of ties it all together, is that it is not just about cash in the bank. It is about all your assets. It is about the resources are also the people around you. It is about the fact that what the smart investors do in tight markets is that they leverage everything they have around them, and they do it in a smart and wise fashion, right? They tap their equity. They have the equity sitting there so that they know it's a good time to pull cash right now. I've got it sitting there. I know I'm not using it, but it sits there and it's ready to go when it needs to be used. They have their buffers there. They have it ready to go when they need to. They have their advisors. They have all the people around them. Everybody's on the same page so that when they make a call, they know that that person is picking up the call and they know exactly what they're about to talk about, right? And as a bit of a side note, for something that is happening a lot at the moment is super. A lot of people are realizing that super can be a bit more of an active asset. A lot of people had their head in the sand. They just never looked at their super balance. And they're realizing that if they can go and get a leveraged return through property, it is going to do a lot better than the 7 or 8% that a lot of super funds do in their balanced funds. And they can go out and they can deploy that capital. They can get access to property markets which are in tight supply, having great performance, but it's not utilizing the same borrowing that it would be in their personal name. So they might be capped, but they've now got the ability to add another 1 or 2 properties to their overall household wealth they wouldn't have otherwise been able to do.
Which typically the first cab off the rank for a lot of people when they get tapped out serviceability, investing in their own names or in trusts or whatever. So, the self-managed super fund, we're not in the business of giving advice here by any means, but it can be a really good, smart application.
Most definitely.
And the great thing about it also is that you to leverage into shares in your super fund through margin lending and all this sort of stuff, it's it could be risky business, right? You can be dancing with the devil. You only need to see what happened when Trump put his tariffs in, what happened to share markets, right?
Yeah.
Just imagine, and this is the argument around, potentially taxing unrealized gains in your super fund. It just goes to show what happened. Imagine you sit there going, you go, I've retired, I've been working hard for years and years and years, and the next day, Trump comes out and goes, I'm putting tariffs on everything.
Yeah.
And you watch your wealth tank overnight and you go, how did that happen?
Yeah.
And if you've leveraged that, oh God, man, the bank comes knocking on the door saying, we'd like our money, please. It's very, very different leveraging property.
And I think, like you said, obviously none of this is advice, but I think that the biggest problem that comes with margin lending, which is realistically the only other main way that any everyday person is going to be able to leverage their super fund, is that markets trade every second of the hours
Trading
that they're open,
yeah.
right? And if you're on the wrong side of the margin and you get hit with a margin call, you have to sell. You're done, right? And it could bounce back 2 weeks later. Yeah. But you're done. Right?
You got to find that money quickly.
Exactly right. Yeah. So but then you look at something like property. Let's say in the worst case that your property goes down in value. I'm not talking about just like a natural correction of a few percentage. Like let's say it goes down 15% or something. The banks don't make a margin call on you. There is that forgiveness sitting there, and historically, property tells us that it should be right, basically. But even past that, if you bought smart, that shouldn't be a position that you're in to start with, and you can more safely leverage. And you're now in a position that, like, let's say you got 200K. Let's say you go buy a property with 200K. We'll just keep the numbers easy. Let's say you're at 500. You buy a 500K property with it. In 10 years, if that goes up to now being worth $1 million and you took out the 80% loan, do you really think in 10 years that you will have generated 600,000 in returns. And I know there's tax on it and all the rest, but like, do you really think that by the time you sell that for $1 million, you pay out your 400K of debt or maybe 350 at that point? Do you really think that you will have made 600K just from your organic contributions and 8% unleveraged returns?
Yeah, if you're lucky.
If you're lucky, and that's just from one property.
Yeah, well, your super funds would have you believe that's the best place to put your money, and for a lot of people, it's probably the reasonable thing to do. And you're now finding that super funds, are going to start providing elements of advice as well, right? And this is changing to financial planning laws and stuff. But again, you've got to get the right advisors to make these calls. Don't listen to me, particularly. I'm not an advisor at all. So none of this is advice, by the way.
But just to round it out on this, because I know we want to wrap up, is the biggest problem with super funds is because we have a mandated investment from a business each pay period on behalf of the employee into their super. Super funds are starting to have to send more money overseas because our share market can't.
Not big enough.
It's not big enough for where we're going, where we're at right now, let alone where we're going to. So a lot of super funds are having to deploy your capital overseas, which is fine. There's no issue in that, but more just the idea that like super funds are used for more than just going and buying a CBA share, right? Like there is a lot more uses out there if it is appropriate for your circumstances. And that's why I'm saying, I reckon at the moment, like 30%, if not more, of all of our clients that come on in a month are super funds. Obviously not the major, but self-managed funds. Individuals coming to do it because the advice that they've received, or they've come and they've said, "Oh, I'm looking at it." We obviously then refer them to get the advice to confirm it's correct for them. There is so much undeployed capital out there that they know is not being used effectively.
Yeah, and your retail and industry funds hate the idea of Australians doing it individually through their self-managed super fund. Hence the reason why there's a lot of pressure placed by those lobbyist bodies to try and...
It takes 4 weeks to roll your funds over.
Yeah.
Like, if you think about it, if you were trading shares yourself and you went into your CommSec account, it's T+3. So your funds would be accessible after, like, let's say within a week, right?
Yeah.
And yet there's 4 week rollovers.
Oh, they make it very difficult.
Exactly right.
It's easy to put it in, hard to get it out.
Exactly
the way
right.
it is. Oh, no, it's not a beat up on super funds.
Of course,
so
no.
I think they're very good, and they're a great asset of wealth for the utility that you're seeing. Just look out the windows at a lot of the civil work and constructions that's taking place, tunnels and getting built and all that sort of, like, largely there's the
funded by
the quiet hand of a super fund in there somewhere, right? Who are providing a dough around it, public-private partnerships and
PPPs
and all this sort of stuff, right? Like, super funds are a great enabler, and I'm talking about retail and industry funds. They're a great enabler for the ongoing development of Australia. Brilliant, using Aussies' money for developing Aussie assets and the Australian infrastructure and everything interconnected. But look at the skyline of any city. Most of those buildings are owned by super funds.
Yeah,
that's they've got to deploy their dough because
their
mandate is to provide a return.
Yep.
To their investors, and that is the mum and dad, inverted commas,
can't return cash.
So I still keep a little bit in an industry fund, but anyway. All right, that's good. So lots of info there, Lachlan.
Lots.
So take away this. There's lots of bits there, but I reckon the first capital round for a lot of people, if they haven't had someone independent look at their portfolio, they probably should give you guys a call.
Yeah. Well, I think if there's two, we call them call to actions in the industry, right? No need to be thinly veiled about it. There's probably two. There's two key call to actions or messages out of this, right? First one is, if you have a portfolio and it hasn't been reviewed, and I mean reviewed properly, market analysis, financial analysis on it, the numbers, come and have a chat with us, right? atlaspropertygroup.com.au. It's just our flat website, and then it's /portfolio review, right? We can take care of that for you, and it might only cost you $500, right? So pretty low cost. And I was chatting with an accountant the other day. I've chatted with a few, and they all usually they've all said they reckon it's tax deductible, right?
Yeah, good.
So come and have a chat with us, right? That's the first thing. Second thing is, if you are looking to start or grow your portfolio, right? We've just talked about what smart things people do, and some of the biggest ones are they're fast, they're speedy, they get into it, and they have the right advisors. Come and chat with us, right? I'm going to do something that is a little early probably for some people, but we're pretty aggressive over here at Atlas. It's the reason why we've been growing, doubling, tripling pretty much every year since we started and getting the results to back it up. We're putting out our end of financial year offer 6 to 8 weeks early.
Oh,
right?
Okay.
Yeah. So Come and have a chat with us.
EOFY.
EOFY. Come and have a chat with us, right? There are a couple of T's and C's I'm not going to bore people with on this, but come and have a chat with us, right? And we're knocking $1,500 off our service cost, right, for end of financial year. Now, when you get on a call with one of our team, make sure you mention this to them so that they know, and they can run you through a couple of T's and C's that go along with that. Nothing crazy, but, as all good businesses, there's a couple of T's and C's. Exactly. Yeah. So come have a chat with us, right? But the reality is, take action, right? You need to take action. If you listen to the 5 things that smart investors do in tight markets, we're going to be in a tight market for a long time. Come and have a chat with us. atlaspropertygroup.com.au. Put in your inquiry, and there's $1,500 off that end of financial year.
Okay, there you go. But you just said you put your fees up.
We have.
Okay.
We have.
Giving it back to the man. Cost of living crisis.
Exactly right. At the end of the day.
So you put your money where your mouth is.
100%. At the end of the day, we get damn good results, right? I post them on my LinkedIn twice a week.
Past results
every week.
Reflection of future.
You know what? They're not, but at some point, it's got to reflect something that we're doing right, So,
cool.
If you're not following me on LinkedIn, come and follow me. Every week, I post twice a week of all the results. A property we've bought recently and a property that we've had valued by the bank recently, not by the real estate agent, by the bank, right? Yeah. Real equity that clients are able to draw.
I'm finding bank valuations stacking up better than sale prices at the moment.
You know what? Some are, some aren't. Some are, some aren't. It's one of those things. But at the end of the day, if the bank's going to lend me, that's brilliant.
Take the money.
So
that's good. All right. Well, thanks for coming in, Lachlan.
Thanks for having me.
What's your website again?
atlaspropertygroup.com.au.
I never asked, what's Atlas? Why'd you call it Atlas?
I just had a thing for the Greek gods. I originally was going to go Poseidon with my Navy background, but it just didn't flow like Atlas. And Atlas, it's a map, so there's a bit of that sort of
get it. That makes
imagery.
Sense.
Yeah, and we also hold the world on our shoulders.
Oh, you do?
All the property market in this case,
You do, yeah, okay. Where is Atlas?
Where is Atlas in terms of?
Atlas is a map, but anyway.
Atlas is a map where, I see what you're getting at. We are everywhere. Okay. We are everywhere that is good to be.
First, all right. Well, in a tight market, it's probably doing the right things. But thanks for tuning in, everyone. Hope you enjoyed that. I enjoy catching up with Lachlan. We do it every month or so. We'll get him back in the studio because he's quite a popular guest. We'll see you again soon. Remember to check out smartpropertyinvestment.com.au. Please, reviews. I always get in trouble for not asking for these because Lachlan never gives them, and neither do any of his clients who get all this information on the Smart Property Investment Show. Please, reviews. Keep them coming. More of them, 5 stars if you think that's what we should be getting. It's a big deal, so I'm told. Reviews, just wherever you're tuning into this, means more people will find us and like us and get more of this content, and that's why we've been doing it for 10 years. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.